Welcome to Pro News Weekly. Let's dive into the weekly updates on the financial markets. The dollar index corrected after 4 consecutive weeks of gains. This is typical when national currencies and bond markets come under pressure ahead of important elections. The U.S. is facing this right now, although the dollar is often seen as a safe haven in times of market turmoil. In this case, gold and cryptocurrencies are temporarily trying out that role. However, we would advise against getting carried away with the idea of a dollar crash or a catastrophic U.S. debt default. This idea seems to have damaged most of today's investors. It is more reasonable to see the DXY decline as a pullback after a month of growth. The tactical targets for this correction are 103.8 and 102.8. The former is 76.4% of the initial advance and the 50-week moving average. The latter represents a pullback to 61.8% of the advance, which could fully recharge buyers. The major U.S. indices began the week with an attempt to return to growth, but were choked by selling. Once again, the laggard was the Dow Jones, which slipped below last week's lows, losing 3% from its previous high on 21st October to levels near 42,000. The Nasdaq 100 briefly approached 20,700, almost repeating its mid-July high. But the cold reception to reports from heavyweights Microsoft, Meta, and others triggered a fresh wave of selling. Back then, the Nasdaq 100 went down 18% from its July highs, close to bear market territory, and tested the strength of its 200-day moving average before turning upwards. Nowadays, the 200-day moving average is at 18,900, and the bear market threshold is at 16,600. Historical seasonality is now on the side of the bulls, both in the 6-month outlook and for the rest of the year. But many remember well that the 2022 bear market began in November 2021 with a peak in the Nasdaq. The outgoing week had the most weighted companies reporting. Their combined capitalization exceeded 50% of the weight of all S&P 500 constituents. The market's reaction to the performance of the heavyweights was mixed. Alphabet has been working on the efficiency of its AI solutions, with a focus on lowering the asking price and creating value for advertisers. It seems investors needed this shift in focus to practical implementation. After the report, they rewarded the company with a 6% rise in its share price, which slightly pulled back the next day. It's a different story for Microsoft, which lost up to 5% in after-hours trading on unimpressive results from its Azure cloud business. We also see a 5% drop in net margin to $34 billion for the quarter, compared to Alphabet's 13% rise to $28 billion. Meta impressively beat forecasts, but is losing ground after the report. We attribute this to the outperformance of the share price, which was most pronounced in the second half of the year. Since the beginning of the year, Meta shares have gained more than 70%, while Alphabet has gained 26%, and Microsoft has gained just 16%. By comparison, the benchmark S&P 500 is up 23% over the same period. Gold is in its 4th consecutive week of gains, the last 3 of which have been in the mode of regularly updating all-time highs. In futures, the price rose above $2,800 per troy ounce, while the spot price stalled slightly as it approached this level. The current rally began in October last year with the first signs of a monetary policy shift. In less than 13 months, the price has risen by 50%. The RSI index has breached the 80 mark on a weekly time frame for only the 6th time in the last 15 years. Corrections have always followed, with the lowest being a 5% correction in April this year. On other occasions, pullbacks have been between 8 and 20%. But there is an important caveat to this tactic. A signal for a correction begins when the asset returns from overbought territory. Before this point, going against the trend is challenging, as price changes can be highly volatile due to waves of short position margin calls. Bitcoin came within a hair's breadth of an all-time high on Tuesday night, but the overall crypto market is well off its peak. Total cryptocurrency capitalization at the overnight peak was $2.46 trillion, down $2.48 trillion from the July peak, almost 12% below the March high of $2.77 trillion and around $400 billion below the all-time high reached in November 2021. Bitcoin has been the main driver, gaining momentum since Saturday. Trading near $72.4 thousand, Bitcoin appears to be moderately overheated, leaving room for further strength. Markets are gearing up for a whirlwind week of reactions to the monthly jobs report, U.S. polls and election results, and the Fed's interest rate decision. According to the latest forecasting models, Harris and Trump have an equal chance of winning. The entire battle centers on the swing states, with Democrats closely analyzing the Republican strategy from 2016. This means the suspense will likely persist right up until the final moments. Some observers are preparing for recounts in the coming days or even weeks. The Bank of England is expected to cut interest rates by 0.25 percentage point to 4.75% on Thursday. Two-thirds of economists do not expect a cut in December, and the central bank's task will be to manage these expectations, which will affect the pound. A willingness to cut further could weigh on the pound, while a desire to pause would strengthen it against the backdrop of competitors, including the ECB and the Fed, which are ready to cut at every meeting. The markets do not doubt that the Fed will cut by 25 basis points on the 7th, and are bracing themselves for another such move in December. The probability of such an outcome is around 70%. Fluctuations in these expectations are the biggest potential source of market volatility. However, they will be influenced by both the tone of the statements and the two inflation reports in November and December. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.